So hi everyone. This is Finance Meets Real Estate. We have webinars on most weeks here. So we have like amazing guests. We've had like over 100 guests, industry-leading guests from the industry so far. And we do networking socials as well, just as today. So we're just gonna kind of like do a casual meeting with, basically like everybody sharing what they do. If you guys want to share your screen, also show us your company, what you do, that's absolutely permitted with, moderate marketing. I think that's fine. So yeah, basically that's it. So we're just doing like just networking. I'm gonna start introduce myself, and if you guys want to follow suit, that would be great as well. So let me just 1 second. So I mean, most of you know me, but right. So I'm a founder of Realty Quant. So my company publishes market valuation metrics. So if you want to know which markets are overvalued, we're pretty much probably the best vendor out there. And yes, so that's one thing I do. We also publish property analytics. So sort of like an add-on to CoStar. Is a second product that I recently released, which is essentially modeling rental listings data for commercial multifamily. And also I'm an investor, so I do like residential and commercial deals, mostly in the Northeast. I'm doing 2 commercial deals now as well. One of them is a syndication. So if anybody is also interested in investing as an LP, feel free to reach out. I am, my personal investment thesis is investing in undervalued markets. So I've been like pretty vocal about that on many events as far as like what I think in terms of relative performance in a recession for those. So that's like my strategy. So current deals, they're both in the Northeast. And that, so previously, financial engineer, so I went to Columbia, New York City, Eastern European originally. Went to Columbia, worked in the financial industry for about a decade, used to manage like 90 billion derivatives portfolio amongst 5 people, so myself and 4 others. And and I've been on over 50 podcasts. I've done some university lectures, I've done some summits and so forth. So that's pretty much, but yeah, kind of technology side. So I've been working recently, like I mentioned, on the 2 deals, so 2 commercial deals in the Northeast, a 34 units, so not too big, like 34 units and 26, I guess. I mean, prices are a little bit higher also in the Northeast for some of those, but that's pretty much what I'm working on now. And and I've been speaking to like to the lending industry essentially on some of my startups data that we provide. So that's what I work on primarily myself. And so that's about it. If you guys somebody else wants to kind of jump in, I see a couple more people coming over. Just feel free to kind of raise your hand or.
Yeah, I can go. I don't mind.
Yeah.
Go Don.
Yeah. Yeah. So I'm Don Spafford. I've actually been a guest on Stefan's podcast here before, as well as Douglas is on here, and maybe somebody else that might be on here. I've been on several myself, but my team and I we work with Happy Camper Capital. We purchase RV campgrounds, resorts, and marinas across the country. It's a very unique asset class that kind of getting a lot of attention lately, as people are looking for something outside of what's the norm is happening. I guess just looking for better, higher cap rates, better returns, and we can provide those and deliver those. We currently have a 506c fund, which we are raising capital for that fund to invest in multiple campgrounds across the country at the same time. So if you're looking to learn more and invest in some of these deals with us, I'd be happy to talk with you.
Sounds good, Donia. Do you want to show us? I know I've looked at some of your deals. Do you want to share your screen, like show us what you guys are working on right now?
Sure. Let me get something pulled up then.
Yeah, sure.
Hang on a second.
You in the same markets as before, or new ones?
Yeah, so again, we purchased across the country. So we've got in fact, just today we got one under contract finally. It's been a long time in the process in Ohio. We've got one set to close in a couple of weeks in Louisiana. It's going to be one's going to the fund. Another one from the fund coming up in Arkansas. Working on a marina in Tennessee. So lots of deals coming up.
Sure. Awesome.
Let me see here. Let me find my stuff here. Wasn't prepared to present anything, so
yeah. Surprise.
Yeah.
Were you at Cash Flow Champs, Don? Were you at that event recently? I'm not sure if you were the past weekend. It was pretty nice. I liked it.
Yeah. Hear me. Let's see here. To share screen. I'll try this. Okay. So we can see that, right?
Yep.
All right. So I guess I should pull the. I meant to pull the. Yeah. I meant to pull the PowerPoint. I got the PDF. Either way. So Happy Camper Capital. We also have Beyond Our Camp. Beyond Our Camp is our campground management company. They manage, of course, our own campgrounds as well as other third-party campsites as well. So if you own a campground, need help with management, we can help with that too as well. I'm going to quickly go through some things here. So again, we buy RV destinations, not mobile home parks, not the same thing at all. Let me go into some of our deals here. We were just a couple weeks ago in Orlando for a big RV campground convention conference going on. We had a booth there for essentially both companies were represented. It was a pretty cool event. Seen lots of great things that are coming up in the industry. Here's our current portfolio of what we currently own and operate these 4 properties now. See some just example returns here. We're talking big numbers usually. Like 15% cash on cash is typically our average we're shooting for. 20% plus IRRs in general. We buy multiple different sizes of properties. Anywhere from like I think this one here is like a $1 million or so up to the ones you have currently in a contract are like 12 million, like this one here. Almost 3x multiples. 19% plus cash on cash for a 5-year average. So some great return possibilities. And again, here's some information about our fund. It was just recently launched like this earlier this month. It's been featured on several media outlets like Yahoo Finance, TV Ameritrade, some industry specifics, Woodalls, Modern Campgrounds, RV Business, all these different companies picked up that lead to kind of just share it on their media sources with us, and we've had great interest come from that. And here's just for our fund in general. It's a 65-35 split LPGP. Different preferred returns based on the amount invested. Different share classes, A, B, and C, and then these see these IR thresholds: 21%, 2019, even the low end, we'll say the 19 Class C is still generally higher than what you're seeing on most other cases. And that's before we kick into the waterfall, which comes after that at a 50-50. So of course, like I said, you go to happycampercapital.com to learn more. And you can even go there and find my information and schedule a call with me if you want to talk directly about it.
Awesome. That's great. Great returns, guys, actually. So that's, target returns, right? In that way, at least. So kind of more potential more potential, right? So
exactly. Yeah. We get, I'd say, I don't know, 95% of our deals are sourced off market. We call up the campground owners directly and negotiate a deal with them. About half of them are seller financed as well. So we're typically not competing with anybody else to outbid somebody just to get a deal. So it helps because there's lots of leverage to work out great terms up front.
That's great. Awesome. Yeah. Awesome. Thanks, Don, for joining. Always a pleasure. And so if you guys who wants to go next? Just to raise hand.
Yeah, I will go next.
Yeah, Casey, good to see you.
Good to see you. Yeah, my name is Siva. I'm from St. Louis. I'm a passive investor. Not much share.
We spoke with you over right, and you said that at the event, so we attended the same summit, the same. This was pretty nice. Cash Flow Champs, I recommend it.
Yep, it is.
So sounds good. Yeah. So which deals have you done? Like in which markets? It's an LP. Searching for, right? Okay.
Yeah. I did one in Ocala, Florida. Yep.
Okay. That's cool.
Yeah.
Sounds good. Yeah, thanks, you. Appreciate it.
Welcome. Yeah.
I can go next.
Yeah, sure. Go ahead.
Hi, guys. I'm Douglas Dell. I have the Real Estate Macro Podcast as my current passion project. Stefan would love to have you on. If, by the way, anytime if you're still looking to do some podcasts, had a good time. Don had a great time on my podcast. I think we had a great chat.
Oh,
and
yeah, that's
for sure,
awesome.
Yeah, I'd love to have you on. Second thing, working on a debt fund currently. Special situations and gap funding is our debt fund that we're currently working on, and we also do have a ground-up development deal in Colorado we're working on.
That's awesome. That's great. Do you want to share your screen? Do you want to show us some visuals, or?
Yeah, I guess I can take a quick look at our pitch deck for the Colorado deal.
Yeah, sure. Yeah,
it's
that's
an
okay.
Interesting deal. Let me see if I've got it here.
The 506C, right?
This is actually not a fund yet, so we're in pre. We're not even a fund yet, so we're in pre-development. So I feel comfortable sharing it. Let's see here. The thesis of the project is it is a rural project. Let me see if I can get the slideshow going here. We're capitalizing on the work from home play. Actually, it is rural, so we're very, very inexpensive. We're talking $260,000 for a 3-bedroom, 3-bath house.
Right.
So very inexpensive. We also do have 3 duplexes we're going to develop in the process. So I mean, literally, that's a picture from above there of what we're talking small town Kansas, Colorado type look here. And IRR is going to be 29% north of that. We think it's actually going to perform a lot better, but we don't want to freak everybody out with the monster IRR. Equity multiple north of 3. And I'll just go real quick down to the numbers here real quick. The rental numbers are going to be pretty stout at about $18,000 a year or per month for the duplexes, per duplex per unit. Well, actually, for all the duplexes, 18 total, I guess I should say. And then we think the absorption numbers has been fun to model. We're not sure how fast the for sale component will model out. So we did a very conservative once every 3 months sale. So that's the interesting part of where we're trying to still figure out what we're doing on the modeling for that. But again, the numbers, the land is very cheap. The entitlement process is like, hey, please build here. It's not a long drawn out battle. And our cost to build is exceptionally inexpensive for what we're getting.
Yeah. So Gabriel is asking, like, how are you calculating your IRR?
We are doing. I guess I should ask what exactly are they driving it on that? That is unlevered versus levered. That is a levered IRR, if that's the question.
Yeah, I was just trying to see how you're calculating your numbers here.
Yeah, absolutely. Yeah.
I mean, I guess, is it how many cash flows? Let's say, is it like time 0, time 1? It's like a 1-year project, or I mean.
Actually, the way we're looking at the way we modeled it, it could go really anywhere from 1 year on the sell to we were conservative and we did 3 almost like a year and a half to 2 years on the sell portion. The rental portion we think it'll absorb right away in terms of the rental market. So the 6 units of duplex we think will rent up pretty quickly. There is a hospital in this town, so that's who our primary target is. They have a lot of traveling nurses and they just have trouble keeping staff because they're not finding any place to stay. That's one of our big objectives.
So the 29.
I ask what inspired? Sorry if I'm interrupting anybody. I just wanted to shoot this question. What inspired this project? Why this location? And
why this location? My partner is in this town. He's got 22 years of construction experience, and he is from this town originally, and this is where he lives currently. We do intend to roll the building style as post over beam, and let me see if I can show you the duplex. It's very inexpensive building style. And I will say our long-term objective is to hit up towns like Leadville and Fairplay, Colorado, towns close to the ski areas. But we do have and he's actually built this design already once for his parents, and then also done this house here with a similar style.
Is it a build to rent?
That is our overall long-term objective.
Okay.
But we are going to do also build to sell with this type of model here as well.
Okay.
So when we do have that flexibility too, if we get out on the market and the sell market is just not working, we definitely could do build to rent also.
Okay.
And are flexible on that point.
Great. So but the 29%, it's a 2-year IRR, right? Sounds
right.
like. Is there a refi like at the time you
that is our objective also, is to go ahead and refi out all the capital. And that's not, I'm still modeling that. I'm very new to the modeling of a development deal, so I'm still working on the model.
Sure.
But I think that is exactly the objective, is refi all the cash out. You have all your capital back, and we have duplexes that are being paid off by the debt.
Cool. Sounds great. Yeah, thanks for sharing.
You bet.
So we've got, that's like development. You guys, are there any, like, besides Siva, like any limited partners or like people who are looking to invest in like Douglas or other projects in the audience? If you wanna
hey guys, I just wanted to take this chance, introduce myself and I joined this group. This is my first ever meeting of this kind. I just came back from Israel, where I was an investment analyst for a company specifically for real estate. Now I'm working in finance, but my side hustle is real estate and really looking to invest in that space and learn more about it. So that's why, Doug, I was asking about your numbers and how you're calculating them, because I'm just learning the works of financial modeling within real estate developments and all classes of that nature. And what I saw when I was in Israel was a lot of tech development within combining real estate and tech, and them calling that like real estate tech, and that being a whole spin-off of different kinds of housing projects and really cool stuff there. But yeah, that's just a little bit about me. I'm based in San Francisco here.
Awesome. Sounds great.
That's awesome. If I could introduce myself as well, I'd love to. Yeah, my name is Giancarlo. Stefan, thanks for hosting this. This is the first one I've joined as well. I'm still an engineering student. I finish up next semester, but for the past 2 and 3 years.
Where are you studying?
I was at Purdue. Now I'm at Rutgers, studying mechanical engineering.
I just graduated from Purdue.
Oh, that's awesome.
Yeah. Boiler up.
But yeah, I'm living in Jersey right now, and for the past 2-3 years, I've done off-market, basically acquisitions and wholesaling of basically 3 to 5 unit mixed use and apartment buildings. So kind of like Don said, calling up owners, underwriting, negotiating, having those fun conversations. And my interest really lies in the intersection of technology, data, and real estate. And I was really applying it to our acquisitions model. So I created a whole data pipeline. And I've basically been working on a couple kind of software prop tech projects. I'd love to share real quick.
Yeah, go ahead. That would be awesome. Yeah.
Because I put a lot of work into trying to make it look pretty. Let's see.
Yep.
Here we go. I think this is it. All right. So can you guys see the map? Hopefully.
Oh yeah, that's really nice.
Yeah, this is just a visualization I created of all the multifamily apartment buildings by number of units in Jersey. I'm only in Jersey, so I don't really have a nationwide approach, but I have what's local to me and all those data sets. So this is something I've been playing with, and I think I'm going to start publishing like a lot of maps and maybe like some blogs and graphs based on. I've been building some crazy data sets just for Jersey, and I'm also kind of working with some investors and commercial brokerages, trialing a software I created for Jersey to identify distressed multifamily properties, anything from 3 units and up. So I've been working on this for the last, I don't know, 3 or 4 months as a developer, and now going to sell it. So anything, Hudson County is really hot right now with a lot of these brokers. And, still just learning and I'm going to stop sharing the screen now. But just learning and, wanting to learn more and connect with, other investors, principals, brokers, and kind of learn how I could combine the engineering, the real estate skill set to solve bigger problems.
Oh, that's great. So what software did you use for that map, actually? I'm curious.
It's a package or like a library called Kepler.gl. I can send the link,
Sure.
but it's very open source and very easy to use. So I'm going to try and keep developing some map models. I've been pulling like credit data and eviction data in New Jersey, so I want to model some of that.
And those buildings, are they commercial multifamily, or they're also 2 to 4 units, let's say?
So it's 3 units and up. So, okay. But you could actually, there's a way I could filter by a number of units as well. So I'm looking to publish this all on my public blog if you actually want to check it out. Because I don't know if you're in New York or New Jersey.
New York now. It used to be New Jersey, actually.
Mm-hmm. Oh, okay, awesome. But yeah, it's been a big project. So I'm gonna keep working on it, and I'd love to connect with anyone on LinkedIn.
Carlo, I have a question for you. Is that a Python driven, or is that just completely GIS oriented type program?
So my preference is Python, and what I've done is I've converted all those buildings into geospatial, like just coordinates basically, that you can then feed into this model. It's very easy. Nice. Like you could just use a CSV basically Excel. For those like me who aren't super GIS minded or proficient.
I'm not either. That's why I'm asking. I'm like, oh man, I don't really want to dive into GIS where Python's a little bit more friendly to get into.
Yeah, that's.
Can I ask you a quick question? Sorry to interrupt then again, but where were you pulling this CSV or the data from? Was it from a website, or where was this info available for the apartment complexes?
Yeah, it's basically all related to the software I'm like developing with these commercial brokers, and I scrape most of my data from so a lot of it comes from all public sources, and it's just a matter of compiling them.
Yeah, that makes sense. I was wondering if it's like a government posting of these properties, or if you built out your own website and kind of compiling and harvesting all this data.
I wish, but since I'm a student, I mean, I'm not working with a ton of capital to buy the big boy data sets that CBRE or all these crazy guys have, because they have really intense cell phone data, where everyone's walking.
They have bots that farm different, and they're updating every second for these.
Yeah, and they have credit card data.
Yeah, exactly. Well, really cool stuff. Regardless, this is really cool.
Yeah, it was really awesome. Awesome project to be working on, Giancarlo. Kudos. That's really cool.
No, I appreciate it. I've been doing acquisitions, but really I think I want to transition to more so the software side, and something a little bit more scalable, and that kind of takes my engineering skills into account a little bit more. But maybe I'll keep doing a little bit of acquisitions for myself, hopefully.
Now, Stefan, is there any way we can integrate Black-Scholes into this model?
That's a good question, right? Well, you can try.
It's have fun with that.
Yeah. I mean, yeah, Black-Scholes is, it's quite easy, but yeah, I mean, it's obviously very limited application, right?
Yeah, right.
Options, but yeah, you come out of, so you mentioned Douglas, you were in finance before, or?
Oh, was that to me?
You were where?
Yeah. Actually, my quant finance is my hobby, I would say. So I'm reading stuff like Dynamic Hedging by Taleb and folks like that.
I've worked on dynamic hedging projects and all that. Yeah,
that's awesome stuff. I was excited to talk to you a little bit about that. I saw you did the MFE, and I was like, man, that'd be fun to talk to you about that kind of stuff.
I know. Yeah, you're right. Yeah, that's true. That was my prior career, pretty much, quant finance. Yeah, that's what I do. But actually, since John Carway is showing that, like we have a few products on the Realty Quant side that maybe I'm going to share at another meeting, since kind of on the technical side, so it's kind of to allow like others to talk. So who wants to go next? Like perhaps Rick, to kind of pick out from the crowd.
Me?
Yep.
Oh, I was sitting here ducking and covering, but you still spotted me. I've actually got to go in about 3 minutes because I have a mentorship thing. But I'm Rick Ward. I'm in Boise, Idaho, transplanted from the San Francisco Bay Area where I spent 50 years. And I just acquired a private equity fund of funds, which I'm in the process of finalizing a couple of LLC transfers, and I'll be rebranding that on the investor platform, if any of you are familiar with that. So I get to play matchmaker between finding some really quality deals and sponsors, GPs, and matching those up with some interested LPs. So that's my job now.
Well, hey, Rick, we can definitely help you out with that. And I didn't mention I'm also in Idaho. I'm on the other side of the state. I'm in Idaho Falls. So
okay,
we have another Idahoan on here.
Yeah, nice to meet you.
Yeah, you guys should connect, absolutely, over there. And actually, so I'm curious, like, how does it work? So you purchased the business, basically. Sounds like you purchased it with all its systems and everything, and like, what was your experience in terms of like all the capital relationships and so forth, transferring actually?
Well, that's our next test. I'm working with my SEC attorney, who you probably all know, Mauricio Raould and Bethany LaFlamme. They're my people. So because we have to disclose all this, and this actually gives the existing investors the option to exit. But this fund had a transition once before, and they all stayed in. So, and I'm the fund, I'll be the new fund manager, but I'm keeping the other one on for a transition period just to gain comfort for the investors till they get to know me and everything. But yeah, it's been relatively smooth so far. So it's just now I'm just building up. And the reason this was really available, these guys started this thing originally with someone that was the capital raiser, and then that person departed. And all the investors, the original investors, were high-income Silicon Valley Apple employees. And the one that got them all together went to some other thing. So the other partners, they're more on the GP end of things. And so the capital raiser left, and they didn't know what to do with this fund. They didn't want to be fund managers. And so I kind of doing them a favor, but they're also helping me because it's an existing fund. We already have some deals and some investors, and just save me time and money. So that's my next thing, is build up my own funnel and get going on this. So
that's great. And so what's your investment box, so to say? Like, what kind of regions and deals are you guys looking at? Like, what deal sizes and geographies?
Are you still asking me?
Yeah.
Oh, sorry. That is part of what I'm defining now. The deals that are in there now are not real big. They have a mix. They have they had a hotel to multifamily conversion. There was an Airbnb. There was a value add. There was like 4 or 5 deals, those kind of deals, the smaller deals. Personally, I'm a value add guy, but with this economy and everything, I'm really more interested in cash flowing Class A stuff, as well as I have my eye on the industrial properties. I've been watching that, self-storage too, and I'm really interested in this camping, this whole thing. Talk about a niche.
Yeah, that's great. That's true.
So, but my fund is set up in a way that I can cross any asset. I can do crypto. I can do new business. I can do hard money loans. It's a very unique, customizable fund of funds that I can have multiple kinds of asset classes.
Right. Understood. Yeah. So I can connect you. I have an opportunity I got introduced to recently that I've been trying to help them. Can connect you. It's like an institutional Class A. It already closed actually. They're looking for like 3 million in equity, but they only want like a bigger check basically. So like 1 million plus, something like that. So if you guys would be interested, it's like a 20+% IRR for Class A, which is it's like a 41 million the deal, basically.
Two of my sons-in-law are physicians. One of them's an orthopedic surgeon. They've got all their buddies. So I'm hoping that they'll all be interested to come to bring their buddies and friends. I also had 2 surgeries last year, and when my surgeon, when he gave me clearance to get back to living again, he says, "Now what are you going to do?" And I said, "Well, I'm doing the multifamily." He really perked up because his dad is also a surgeon, and they've already been investing in single family. When I told him that, how much better multifamily is, he perked up and he said, "Well, how can I get into your deals?" So I'm hoping that that's going to be my avatar, that I'll be able to take off with that. And in that case, maybe I can come up with these bigger checks if I can get into the right mix of people.
That one is like very specific. Yeah, I'm kind of mentioning because they're pretty much looking for like somebody who maybe needs a 1031 or something like that. Like 1031 exchange, or sort of somebody who needs to get into a new deal basically. Usually that's the story there, right? So it's an interesting, it looked like a good deal. I like the market, I like the property. So
are the GPs experienced?
Oh yeah, very. It's like a top kind of experienced syndicator from New York. I mean, he's done like thousands of units.
Okay, because that's one thing. I'm going to be very, very picky.
Yeah.
I prefer to have people. I just talked to somebody yesterday who gave me some good tips. He says, "Look," and this is someone that's raised big money. Mm-hmm. He says, "I don't work with anybody that has less than 20, preferably a minimum of 30 completed deals."
Right.
And that gives you, rather than someone that's bootlegging it, this is their first or second deal, that's the way I work best. If I have a team, or if I have GPs that I know they're not going to embarrass me later, people that actually know what they're doing, then just wind me up and I can go sell that. But if you have this wonderment, or you're questioning if they're going to perform, that's harder to sell.
Sounds good. Yeah, I'll ping you after this call. I will. I have your email. It's
okay. I appreciate that, and I do have to run now.
Yeah.
It's been really good. Rick. All right, take care.
Cool.
See you, Rick.
So yeah, who I pull up? Yeah, perhaps like Shodan. Do you pronounce it correctly?
Hey Stefan, this is Shodan.
Yeah. Hey, how's it going?
Hey, pretty good. Yeah. So I'm in Denver. And I'm pretty new to the whole real estate thing. I'm kind of learning and, trying to network. And Douglas has been kind of mentoring me.
Oh, nice. So you're in Denver. So are you guys working together on the development project? Nice. That's good. Yes. So what are your interests? Like basically development is your primary field that you want to grow in, or like where do you see yourself basically in the future?
It would be more like raising capital.
Raising capital. Oh, that's cool. That's great.
That's a good one.
Yeah. You're helping Douglas with that, yeah? No?
Yeah, we've been strategizing.
Yeah, I think we're going to be primarily looking for multifamily opportunity. We think multifamily is set for some. Multifamily is about to go through some things. We think. Yeah. So.
Right. Do you guys have any concerns on the kind of recession or the market or anything like that, or?
Right. I think that me personally, I think the most of the pain is going to be borne out by someone else. So basically, the people that originated in 2021, the bridge debt, no fault of their own, they didn't have this interest rate spike on their model, and unfortunately, their pro forma just got blown up. I believe that the long run economics are still pretty solid of multifamily. It's just that the financing is going to be problematic. But the demographics create a floor, and the supply constraint create a floor to the market as well, I believe. So the long run outlook for multifamily is excellent, I think, but the financial distress is going to be significant.
Mm-hmm. Right. I see. But do you have? I can show you what. Do you want to see like what my company has? It's kind of on the.
Would love to see it for sure.
Yeah, the housing market. Let me show you. I mean, again, it's so let me just not that. So this is at the second quarter of this year. This is the housing market. It's not commercial, just the general housing market. Governmental data, and these are sort of under valuation based on like fundamental analysis, historic income, population, and housing supply. So that's what you're seeing. So for instance, if you see, I don't want to pick, if you see like Texas, so Texas is like 33% above its historic sort of fundamentals. And this is very recently developed like this, actually. So through even the first quarter of last year, this map was like the numbers were way lower. And if one took the whole US and you say, and it's beginning 2021, and you take the whole US, was right around 0%. And so, because I've been doing like lectures on this for probably 2 years, and so the narrative was it's always like fairly valued and all that, but it kind of changed, with inflation. So now latest has been like that, and now we saw in like some of the same states, basically like here. Now this map is not very good; some percentage don't show up, but basically the same overlap of states with Tennessee here, with Florida, Texas, and these few Western states is where we saw the highest percentage of listings taken off market. So percentage of listings taken off market to sort of historic overvaluation like that, the map is almost exactly the same. But percentage of listings with reduced pricing, not taken off market, my bad. Percentage of on-market listings with price reductions. And that's just a very transitory indicator, of course, and so forth. It's kind of like noisy perhaps, but yeah, so some prices perhaps a little bit reducing here and there, but that was at Q2, end of June actually, and because some of the governmental data is pretty slow, but that's kind of how it looks. So like some of the West is a little bit more concerning, and so my company, like our approach, so we look for my approach at least has been like sort of all the other ones, like all the lighter colors here. So Midwest, Northeast, there's a bit to the south as well, but generally that's it. And so now I'm doing one deal in New York and one in Maryland. And that's not to say that those are the best states to invest in. They definitely aren't. But there is less market price risk there right now, short of all the other operational or rent control, those issues that one needs to navigate, to basically not invest where there's rent control and so forth. But generally, the market risk is lower right now. And then there are like some other studies I can share on that. If you guys kind of care about that part. So it's like this kind of a very big table, but just to give it it's like if you invest, let's say here, these states, they're like 40 to 60%, some of the Western ones. What this is saying is, but it's in metro areas. So these are metro areas here, like the 400 metro areas. This is saying that if you invest, let's say 40 to 60%, even if the very mild recession falls like 1990, generally there is underperformance. So, and if there's a severe recession, also underperformance, and it's almost perfectly ordered, it's almost like physics, right? It's like basically you get like the highest valuation bucket 10 years ahead, up to 10 years has the lowest price appreciation, and so on and so forth. And so my company started, that's my approach. I don't do very big deals generally. Now the current ones are 26 and 34 units, but looking for bigger ones as well. But our approach only undervalued, like in the -10 to 0 under fairly valued range, because what the data shows is that outperforms following even a mild recession, and decline durations are extremely low in a mild recession after that, such as of the order of a few months, like here. And in a mild recession, if you buy something overvalued, your decline duration could be even higher than a severe recession. For instance, an example of that is here was Hawaii before 1990. Decline duration in Hawaii was 8 years. So not 8 years later, in 98, prices were like over 14%. And, so sort of trying to avoid these type of scenarios for me. So lower decline durations in undervalued. It's the flip side of this is those markets are typically not great because they weren't the best doing markets right now. It's a legitimate thing. So there is a bit of an operational risk to market risk trade-off. But for me personally, the market risk, I don't want to take. And also another interesting thing is, so looking at this, so if we say that broadly, if we split the US, let's say in West, South, Northeast, and Midwest, just if we say it's those four regions, I mean, there are other definitions, then the West and the South are broadly in the 20 to 60%. And then the Northeast and the Midwest are broadly in the minus 10 to 20%. And so what this is suggesting is that it's not that the Western markets, they may not be booming the next market cycle, they can be, but it appears, at least for a decade, if we do get a declared mild recession, at least for a decade, that wouldn't be the case.
Stefan, I want to make sure I'm tracking. Would you agree with the assertion then that Las Vegas and Phoenix both had a really bad 08, and it feels like they're about to have another repeat of that in a way? It looks like that according to this data.
I mean, you mean in commercial or in residential?
Just generally, but
the housing market, right? Okay.
Yeah.
So generally, yes. I mean, that's. I don't know. You know what I think on this? My opinion. I don't know. The way to predict if they have a bad decline or not is sort of like economists predicting economic growth. Because let me tell you why. My opinion. Because the reason is, the current level of valuation is already built into the market. At metro areas is almost scientific. There's correlation of these declines, like global financial crisis, these valuations here. You can just look at these two columns. The decline that was and how overvalued they were was extremely highly correlated. So that's close to 90% is the correlation of the two, actually. That was before GFC. And so this is already built into the market. It's not something like forecasting. Now, the part that is forecasting is, I don't know whether they'll have it very bad or not. I don't have knowledge to that. And the reason is that's forecasting income growth, basically, and all those fundamentals, how well are they going to develop? And the reason why global financial crisis was very bad is because the fundamentals, they recovered in an extremely weak way. And that's been like global financial crisis classified as like one of the worst recessions of the past 2 centuries. But 1990 was an extremely mild recession. And because it was extremely mild, okay, so if you have something that's 50% overvalued, it can decline only 15, only 1.5. Because all those fundamentals, they're going to catch up. Incomes are going to grow in the meantime over these 4 to 6 years that often declines happen. And incomes are going to catch up and you get it milder. So I don't have basically any information. I just know what valuation is good to the market. I don't have information as to whether they will decline like here or like here. I don't know if we have a mild or severe recession, but most likely something between these two, because this one is like one of the mildest ever, and this one is the most severe ever. So sort of something of that would be within this range, but I don't have a forecast to that. But are they overvalued? Yes, because here is current, like some of the, most overvalued MSA. So that's where Phoenix is at 50% overvalued. It's right at the top. Las Vegas is following these. It's like maybe around 40 or so. It is there. There's also Tampa and so forth. Boise is number one. Boise's been number one for 2 years. It's also number one in everyone's ranking. It's number one in Moody's. It's number one in Florida Atlantic University. It's number one in our data. And so it's a pretty big consensus on Boise. There's just no question there. And so that's what it is. But again, that doesn't mean, I just want to say, like sometimes when I share these things, it's like you're some kind of bearish analyst or something. I'm not actually bearish at all. It's the only thing it means is because you can actually look at the counts to the right. In a mild recession, Boise that's so much overvalued would decline only 19% in our model, for instance. And so that's not much. I mean, it's a lot, but it's not that bad, right? I mean, for some, it's so much overvalued. So it's anywhere between these numbers, but that's for like economic growth forecasting, somebody who can guess where income levels are going to be, let's say 5 years from now, like something like this. So I don't have
Stefan, quick question about that, and I'm going to really geek out here. If I wanted to model that about what you're talking about income growth,
yes,
would Markov Monte Carlo be a good tool for that? Trying to make some guesses.
Honestly, I don't even do like all these fancy. I don't. No, I mean Monte Carlo is kind of like simulation and kind of like where you have like probabilities and things like that. I mean, I don't even do any of this stuff here. This is like just basic linear modeling. I mean, there's no good way to forecast income or forecast population, in my opinion. You just have to do like, so those, what is it, ETS, there's something called Facebook profit, exponential triple smoothing Facebook profit. There is just the seasonal ARIMA, like all those old econometrics models. That's still until now seems what people are using for, in terms of your questions, like forecasting time series or something like this. So for forecasting time series, the models are like pretty basic. There isn't like even too much new stuff that has come out of machine learning, it seems, from what I saw. Because I've tried to do like a bit of forecasting, but yeah, honestly, I don't even do that stuff. It just this is like basic linear analysis. This is sort of like doing fundamental studies in finance. It's not even quantitative, in my opinion. I mean, it's sort of quantitative. It's not even mathematical so much.
Yeah, I have to agree. What I'm suggesting is probably too hard piled for most things, but it just fascinates me almost.
But what would be your idea, Douglas, actually? Because you're on top. So let's say Monte Carlo, how would you help you? Let's say if you have in a region like the time series for income, and to just, how is that gonna help you? Because it's not Monte Carlo is, one can use it like also in option pricing and like other things, but I don't know. Unless you have, maybe I'm missing something, but unless you have an idea on that.
Yeah, I'm not there yet. I'm still learning, and I'm like, I'm not super quantitative yet myself. I want to be smart enough to do it, but I'm like, I don't know.
Yeah. My experience with I dug into it a little bit like last year. Are there any new methods and stuff for forecasting? And what I saw was not that fun. There wasn't that much new. It was all basically I said ETS, Facebook profit, and seasonal ARIMA. Those are kind of like three of the main methods for forecasting time series. So nothing too fancy. Monte Carlo probably not really. For this is all real estate. It's all mostly linear, basic stuff. There isn't like so much non-linear like fancy things going on. So very, very simple. Yeah. And that's how it's. I found it like, honestly, when I switched to this, I found it crazy that you can get like what I was saying, like here these MSAs. Let me show you. This like predictive power, it's like this correlation here is like 88, but I think I got it to like 90 almost. Was like, it's like R. Okay, you can square it, do it around 80 squared, basically. But it's like the correlation between how overvalued and then the declines that happen like 4 to 6 years later, by the way. That's like totally out of sample. So this is so easy. The fact that you can, just in real estate, things are very easy in comparison to finance, it seems.
I love that, and that's been my. We've actually, a friend of mine, I've had that running discussion. One of the arguments for commercial real estate versus equities is, I think equities, the degree of difficulty to beat the market and outperform is a lot harder versus real estate. In real estate, it's not you just have to be really somewhat keen on what's going on where, but it's just not the level of difficulty of equities.
I agree, 100%. They have that in. I am not able to pull it now, but because I don't have it in front of me. But they have like the chart where you have returns dispersion by asset classes, and then the real estate part splits into core and non-core. And core real estate, by the way, has a low returns dispersion. So that's why they say some of those operators, they've had some of these webinars, because usually now we just do this networking, but we all usually have guests normally most of the time. And so, so basically like those core ones where your tenant is like Starbucks or something, and they sign like a 10-year lease, right? The triple net type of thing. And so the returns dispersion was really super low. It was almost like basically like equities. So it seems there isn't much outperformance going on there. But non-core real estate, and keep in mind that was like a compiled by JP Morgan or something. The returns dispersion was huge. And that's like the big notional sizes. Now, guess what happens if you switch to something like what I do, which is like commercial real estate that is basically under 5 million worth of my deals. Not probably have to probably do bigger ones, but like sort of like let's say my current deals are around like 1.5 to 3 million basically. And so what is the returns dispersion there? It's huge. It's just off the charts. There's no comparison. So like any kind of trying to map that to the institutional notional size, but also public REITs or something. Just it's not gonna happen. So I think that's kind of like the explanation, in my opinion. But yeah, absolutely, it's way different. By the way, another thing I can share on something like this, if you want to see, it's not. Sorry, where I had another thing I find interesting in commercial real estate for somebody who is into that is like maybe Douglas, you're gonna appreciate like this part here. It's like the top formula is like the formula for R is like cap rates. The formula for cap rates in like from CBRE or something.
Yep.
And that thing I did like this type of slide, just like kind of thinking about it, showing that actually the cap rate, if you ignore like liquidity premium, is the same, this R minus G here, which is, it's like derived from like a series sum in just like the dividend, basically dividend discounting.
Right.
And so, but then this has some kind of implications. Then if you think about it, because I was having like kind of a mawat on LinkedIn, and like a lot of the sponsors on LinkedIn, they were saying, oh, we have, like when interest rates were rising, cap rates, they have to expand because interest rates are rising. And first of all, like the two have like 65% correlation historically. So they deviate all the time. But one of the reasons they deviate and why they didn't actually expand, and now they can already, I'm sure, at some point, especially in overvalued markets. But the reason why they didn't is because this G grew, right? Because inflation grew the NY. And this is kind of like a framework. And that also tells more stuff that tells that, okay, if we have why actually commercial properties are sold on pro forma, which kind of always looks fishy, you're buying on pro forma, but it's because it actually kind of also fits in the theory because it's this first dividend. It's the next year dividend that should be just in the series sum.
Stefan, you'll appreciate this. A mentor of mine, he said, how the old saying is there's lies, damn lies, and statistics. Well, there's lies, damn lies, and pro formas as well.
There's okay, yeah. I mean, that's the thing is, it should be pro forma that is like consistent with the time zero. There's just something consistent, right? I mean, it's not like pro forma where you need to do the work to get to it, right?
Right.
It's not supposed to be that one. Then that's your value add, and like you're passing your value add, sort of to the seller essentially, right? Instead of like tracking the value yourself. But yeah, I mean, this is just another like simple thing to realize that actually cap rates, they're the same as discounting the cash flows of that commercial property and then coming up with this. And also this gives more insight. Like I had a property in Upper Manhattan that was rent stabilized, 23 units that I bid on in my commercial investing. And it was the seller wanted to accept the offer, but ultimately decided, unfortunately, not to sell because the price was too bad. Because the price was 27% we were asking that they bid earlier this year, the first time interest rates spiked. And actually, the reason I was able to do it, it kind of may sound I was like super pleased with myself because I thought, I like theory and I like also practice, but then I thought, oh, that's like a perfect example of matching because I knew that rent stabilized buildings, their cap rates do expand. And their cap rates, one saw them expanding almost 1-to-1. Now, I'm not saying that's the best strategy because it's also a risk. You can't be buying a falling market type of thing, right?
Right.
But again, it was just an interesting thing. So that was a building Upper Manhattan that basically the seller was entertaining, just fully interested in an offer, 27% below asking. So, so it's interesting. And that I'm sure did not happen in Phoenix or somewhere where rent growth was 10 or 20% or something.
Oh, man.
So anyway.
No, I'm glad you mentioned this because that was my early thing too. I was like, oh no, cap rates, they have to expand because interest rates are going up. And then somebody wrote a paper and it was very much like the same awareness. It's like, well, wait a minute. No, hold on. There is, you make an awesome point is that the growth so far has negated that effect.
Exactly. Because in inflation, then basically inflation grows like this R here.
Yep.
Because because Fed responds with interest rates to the inflation, okay, but then it also grows the NOI, and so there was no effect. But now probably there will be already going forward, also rent growth reversed, right, and so forth.
Right.
But that was kind of like then the story. And
good stuff.
But this is by the so see, this is an older slide. This is at Q1, not Q2. See, Idaho here is a bit lower, so these numbers are a bit lower for the state's overvaluation type of thing. But see where they were, like Douglas, see where they were at year-end 2020, way smaller numbers.
Mm-hmm.
They really rallied with, that's what all investors saying, oh, buy hard assets because it's good, because inflation is good for them. Yeah. Sure, but if your fundamentals don't catch up sooner or later, that's going to be an overvalued asset. And
and the magnitude of the increase in rates has just been eye-popping. It's like, never before have they been this aggressive. It's so interesting.
Well, the rates, that's separate. Now, then there's also questions. There are also questions around this one of how one adjusts these type of metrics for interest rates. And then, okay, so just because you mentioned that one, then I gotta say. So then there's like, okay, that actually, this kind of valuation for all US has been fairly consistent at different interest rates, which is actually interesting. I don't even actually understand why exactly. But I felt, because I could, if interest rates kind of change, I could use something like simple, like 10-year rate, and I can adjust these numbers and try to get more accurate. But then I thought, oh, looks like that's going to get too fancy and like they're kind of like doing too much and then more wrong or something, because then kind of looking at this chart, 40 years that we had before downtrend, or maybe it stopped, we don't know, or maybe not, but downtrend in interest rates. But actually these kind of metrics like this one were not very changed by interest rates. It seems it's not, which one could expect to change, but it's like they're more normalized. They're not, it's not just the prices, they're kind of normalized by incomes and other things. And so it's like, I don't know, that's kind of what this chart. So I figured I'm not sure the effect of interest rates so much on that. Seems like it's not that big, but the rest of the market, it's pretty big. And then another thing, what can I say? Like there was this, so some of, I kind of forget. I think I want to share something else, but anyways. But I mean, now it's a little bit, for me, like, investing in some of those states, it's a little bit not so ideal just in this way. Again, I mean, not like to say, but again, I mean, it depends on the deal. If you have a well-discounted deal, also and shorter horizon, I think that can work out well. Especially,
I think that's why we're not super crazy worried about our deal. Our basis is so low, and the dirt is like literally 30K a lot, where you almost, it's almost so cheap that it almost doesn't matter what happens in the marketplace almost.
I mean, that's great. Exactly. Yeah. So just do that like that way, and at a short horizon is probably, and that's like sounds to me the best. But
And Stefan, based on this, would you say that the risk then in Nevada, Utah, and Arizona especially is asymmetric, and especially Idaho, where the risk reward is inverted, where your reward right now is way riskier if we're trying to get into risk reward?
Oh the risk. This is a great question. So I get this thing, like the usual mindset now that I get from people is, they think if they buy in Austin, Texas, let's say, that Austin, Texas, okay, let it decline a bit in a mild recession, 10%, 12%, whatever. That's what they think. But then it's gonna afterwards do better than everything else. And so that is where my opinion, again, I mean, I don't. It's not an opinion actually, but the study is based on basically actually every recession in the past 40 years, which I kind of then focus on these two. Sorry, that big table. So what this suggests, there is no reward there if you buy this valuation as far as appreciation. It's not that, you have a risk, the downside risk, but you can have a bigger reward that you buy in Austin. No, you're already buying a 60% valuation, 10-year ahead. In mild recession, whoever bought Hawaii here in this to just translate in real life, this was Hawaii here at around 50%. Hawaii had, let me show you, I think I had it on this slide. Sorry, this is Hawaii 91, okay. 91 was 48% overvalued. In 99, 8 years later, it reached, this was its valuation here. Oof. Valuations after by the way, after every recession, I can tell you what I have seen in the data. These numbers that you see here, they all go to zero. Not only do they go to zero, an interesting thing is they go to negative at the bottom. Mm-hmm. So it's actually presents kind of an opportunity. So it's interesting. And so this one, it went to -2 at the bottom to -7%. But guess what was its performance before that? Through 91, 145% it had appreciated. Fine, but whoever bought at this point, they would have been thinking, this is the strongest market with the best fundamentals. It's beating everything else. This is like Idaho today. Mm. But then 8 years later, it's 14% down. And the reason is, I mean, again, I don't know, like that's just based on, I mean, these are 400 MSAs. This is the bucket of all metro areas that were in this bucket combined. That's how they performed. And then the ones in the -10% and less bucket performed like this. It just, I think the intuition and the reason for why this happens is, let's say that Austin or like again, or Idaho or Boise or whichever, like Western market states, etc. Let's say that they have stronger fundamentals than the Midwest and Northeast, which they do. I know that they do. That's why they are there. In fact, the overvaluation and by the way, performance, they have very high correlation towards the end of the cycle. And like this cycle, this correlation of let's say overvaluation now and performance became like 87% or something already. That's kind of almost a little bit indicative that it might be towards the end of the cycle, but you never know, right? Also, we don't know because we don't have a declared recession yet, right? So we don't know. But anyways, but what I'm trying to say is that, so if you, so if you bought, I mean, if you bought at that level, the reason, the one intuition why this underperformance happens, because I've been talking this thing and like basically sponsors, I know like sponsors in Idaho and in Austin too, by the way, like even like friends. And I'm not gonna mention names, okay, now because we're on the webinar, but let's say, so in Austin, for example, let's say, they cannot imagine, like if I tell something like Chicago, that is, weak. No, that again, that's short of all the operational risk in Chicago and like all that other stuff. It's not a discussion of operational risk and whether they're nice areas and so forth. But that something like Austin can underperform now on a 10-year ahead basis, it sounds like, like very unusual, right? But the reality is, or what the data suggests in the past is because I think fundamentals, they compress in a recession. So Austin is going to still outperform in fundamentals, likely, but maybe its outperformance is going to 20%. But now you have a gap versus a market that's that's at -10% or something. Mm-hmm. But now you have a gap of like 70% of valuation that typically after recession, that starts unwinding, basically. And that gap is too big, it's 70%. And even though Austin is a stronger market, I know it's a stronger market, and it perhaps will be, it's simply too big of a gap to overcome, and it ends up underperforming the peers, because when doing this study, I was even surprised how much this bottom bucket outperforms. I didn't expect it. I thought perhaps something fairly valued is going to outperform, because okay, the fundamentals are not so poor, sort of normal, average, and then it outperforms. But the fact that the most undervalued bucket consistently outperformed after these two very different recessions tells something that is just like very valuation driven at the end of the cycle. Now,
Stefan, I'm sorry to interject real quick. And to be clear, this is the total housing market, including multifamily and resident single family. Or
no, this is just, unfortunately, it's not. I wish it was, because I do commercial now. Yeah. I wish it was the commercial multifamily. Okay. I'm not able to do it well there because even like in Costa, you have like the history of cap rates, but you don't have enough. There's enough price history. Just the same study I can be attempting, do it like in very few markets, but I'm not going to get enough intuition. Yeah. And now, honestly, like being like even like at this webinar, mainly interacting with people who are on the commercial multifamily side, because just you typically like we have like syndicators, right? Mm-hmm. And so predominantly, it appears it's not. I don't know. It appears things are sort of in line. Like if you look at like the map of, so again, it's hard to say. That's just intuition. But if you look at like the map of overvaluation in the housing market, okay, I lost it. Oh, it's not here. It's like another one, right? Okay, like this one. So, I mean, it's where all syndicators now have been raving to invest, pretty much. It's the same markets, you know, the Sun Belt and like to the West, it's all these markets where all projects were happening, all big returns happen. And then one can guess, okay, which one is more overvalued? Is it commercial or residential? I don't know, actually. Let's see if we take...
You should have saw what was happening in Phoenix and multifamily.
I saw it.
My goodness, what insanity. It was just nuts. And I'm like this can't be sustainable. There's no way.
100% plus IRRs in Phoenix.
Yeah.
50%
nuts.
Plus. Yeah, I know. Exactly. And so that precisely, Douglas, this thing is telling me that actually I'm not even sure, because you know, like how commercial syndicators, they say, oh, commercial is like more resilient in a recession. I don't know. Their cap rates could be more compressed now. Yeah, I don't know if that's true. I know
my thesis is, and again, I'm still just working on modeling it myself. My thesis is actually this time around, multifamily, because of the bridge debt, is going to have a kind of I don't think it'll be as severe as 2008 was to the single family market, but I think it's going to be pretty rough. I really have to believe that.
My intuition, again, this is just simple guessing and intuition. I also would guess that commercial now could have a bigger hit than residential, unlike the global financial crisis where it was the opposite.
Yeah.
And again, but I don't know if both are going to be big or if they're going to be 10, 15% or what. Like I said, I don't have, this is like economic forecasting or something.
Yeah.
I think what's important is that, like, for me, like some of these numbers, they're already built into the market. And that's what, like, sometimes like I use them as like hard data almost. Where I don't use these numbers as hard data is by, let's say, neighborhood, Douglas. Right. You know, like, let's say, you know, like for neighborhoods, I had a company here like maybe like 18 months ago or something like that. So they do like neighborhood predictions with machine learning. Lofty AI, and they switched to tokenized real estate. You've probably seen them. Yeah. So, but they were initially they were doing neighborhood predictions, and in that one, that's in neighborhood predictions. They're one can do it. You know, I mean, it's kind of difficult to use like social media signals or so forth. But I can tell you, I did this study. I can do it for zip codes too. And actually do, and like in New York City, I look at all the different neighborhoods. You know how overvalued they are, But guess what? It doesn't work so well there. So that's like, you know, like when people tell you, you know, like investors, when they say, oh, real estate, I've got some comments sometimes on this type of data. Oh, this is too broad, you know, like this is just states, or let's say this is just metro areas, you know, or something like that. We just care about our neighborhood. Our neighborhood can do really well. I agree, sure. But what's your predictive power there? Are you going to guess that best neighborhood? That's harder to guess. So if you think of like Douglas, like not like Monte Carlo, take like simple like expected value or something.
Right.
Is your expected value of guessing that neighborhood higher from guessing the MSA? Maybe no. These MSAs, like I said, to me, they're like almost to science level because the correlation is so high. I know exactly what's going on at metro areas, or pretty close. If I took neighborhoods, and I've seen that in New York City, like the neighborhood like right by Columbia University, Heights, where I was going, like when I was younger, like, so it was like that neighborhood appreciated so much. The fundamentals, they didn't even catch up. It had nothing to do with the fundamentals. And there are reasons for that. Just such a small neighborhood, it's not necessarily fundamental. You can have a Chinese foreign buyer buy out the whole neighborhood or something like this. It doesn't need to be so closely needs to, you know, it's just like ultimately it may have an effect, but it's just harder to track, and it's harder to be like super consistent. And so anyways, that's all. Yeah, so it's just, so one can do this. And then, by the way, this data, my company, we have it. Let me just show you. It's not like to be I try not to do like this type of wags things, but yeah, so we have it for like 3,000 US counties actually. Okay, not to go, but yeah, so it's basically like every market in the country, you know, kind of thing. But the way where it's useful, it's not useful for investors much. You know, investors, I do these things because I want to kind of inspire them and give them a little bit of perspective that is new. But the reality is they don't care about these things so much. The main sort of prospects for my company are lenders, like loan buyer companies.
Right.
That's the reality, because they make LTV adjustments. And I was just on a call like a couple of days ago with one of those Pretium, like one of the loan buyer companies, and sort of like that's where so they super care. One of the lenders I was advised actually even almost blacklisted loan buyer. Sorry, almost
wow.
Idaho.
Yeah, they're like Ixnay on the Idaho A.
yeah. So they said, yeah, I mean, they just said, and they had like also different. Another was making like LTV adjustments in very specific. And that I think I'm more skeptical. Like I mentioned, it's harder, but very specific neighborhoods in cities in Florida. So lenders, they're on top of this thing. That's why Mark Zendi and Moody's Analytics, they have this type of data. I was always, even before I didn't know in the past, I was wondering where that data goes. But it's actually, that's where it goes. So they care, they adjust their LTVs. Sometimes they can just fully stop buying loans in those markets if they think it's too overheated. But investors, they don't, because I think their best use is being local and building their agent relationships and building all that. And they're not now, if somebody has built all his business in Phoenix, they're not just going to say, oh, I'm going to move across the country or to the Northeast or something, right? So it's their best use. I think it's not like the industry is not smart. I think it's just they have a different role. They're sponsors, right? They're not. But I think if somebody is a fund manager who is picking sponsors, then they would care and they would kind of, that would be their perspective. So that's kind of, I mean, this is just like simple, again, like fundamental studies. But there's, I think here I had something like Douglas on forecasting. If one wants to see forecasting, and I've done, okay, this is gonna be like for another discussion. This was like how it performed on different forecasting in like 2018, 2019, for instance, when things were like very persistent. Here, the error in like forecasting price was only 1.4%, by the way, like very well. If the trend is the same, you can actually forecast real estate prices. But then it breaks. Okay, then suddenly we get COVID, and now the error was 7% or something. This is a different 7%, not this one here. But
yeah,
was
it
like
seems
7%.
like the problem with macroeconomics is each cycle is so idiosyncratic that you're oh man, you can't get too like certain about anything, really. It doesn't seem.
I mean, yeah, I don't know. There's some things that have a trend, and some things that have a trend, like the real estate prices. Most of them have a trend. Like that's, for instance, in Florida had like very high autocorrelation, very big trend, like close to 80%. And in Florida, while the cycle persisted, even like through now, every year, if you knew the price growth last year, the next year is like 80% correlated to that.
Wow.
Price growth. Yeah. So it's not like, actually, that's what I'm saying. Even these things are easier in real estate. There is sort of a lot of momentum. It fails what in finance is referred to as weak form market efficiency or something.
Right.
It fails that one even, you know? It's like, so honestly, it appears, and again, that I've done these things like very amateurishly. I don't even have a product on them or anything, just like kind of for my own stuff, like kind of like this one. But it appears, well, the trend is there, like 2018, 2019, one can sometimes predict stuff. It's not going to work, you know, like too well, and then it's going to break afterwards and so forth. But one can. But the thing that I like more, I like the downside risk really a lot, because that one is, it's not like I need to forecast what the decline is going to be. I don't know what the decline is going to be. I just know what's currently built into the market. So this is today for me. And
you can really say, well, relative to the risk, it's just not worth it to play in that space.
Yeah, and that's, I mean, yeah, for me, this is just my, you know, that's, everybody can kind of make their own assessment, but for me, based on this table is my analysis of that. Okay, where do I want to invest? It's just like for me, okay, I know if I invest above 20% and above, okay, that's not where I want to hold long term if we get a mild recession. So that's like my perspective. And again, it doesn't mean by this same 20% market, it can come on top after these 10 years. Yeah. That's what happened with Florida. But if you look at Florida, the peak was in 2006. And then in 2020, by the way, the prices in Florida were still below the peak. Just the price history. Wow. Like, you can look it up. Yeah. So the Florida price 2020 is when it caught up later in the year. And so, and now Florida is way ahead of everybody else again, just over the course of 2 years. So
wait till they get some insurance bills for next year. That'll calm them back down.
Yeah, sure, right. Yeah, they have. That's true. They have the insurance thing. I know. Right? Yeah, but basically, yeah. I mean, it's just so this not even. It's not to say that like Midwest and Northeast is going to be the next big thing. I don't know if it will. I don't even think. It's just that it appears a very long time that it takes for all this stuff to get unwound, because like real estate is very liquid. You see like declines, like some people get surprised, like when I say that declines in overvalued markets, they're 4 to 6 years, it appears. That's what historically happened. And it's interesting because, by the way, 1990 is a perfectly great thing to look at, in my opinion, because 1990 was literally a non-event for real estate. And I know we're like way over time like here, but and basically the broad decline in real estate was 0%. 1990, 0% decline. Nothing happened. Nobody speaks. There's no like crisis. Okay, but if you go granular like this, like the data that I'm looking at here, you see that it matters that there is a mild recession, and if you invest in overvalued, and it's all a different picture. The declines are not big. Okay, 14, 17, 12%, you know, whatever. But it is. But on the back of this, how big the decline is a secondary question. On the back of this, there's the same underperformance that you get otherwise, and you're still not in there. It's just like value investing, you know. That's what it is. It's like
value absolutely. But Stefan, I want to thank you so much for walking me through this. It's been a thrill to talk to somebody about the kind of the geeky things that I've been looking into, and looking forward to learning more about it.
No, yeah, glad to chat Douglas more. Like it looks like you're looking at some very interesting things, and
yeah, we're trying to see how we can kind of borrow some quant, and I think the asymmetric risk concept is really not a common thing in real estate, I don't think. And so having just even an asymmetric mindset when you're looking at investment, I think is kind of fresh. And that, and even cognitive bias, you don't really hear talk like real estate investors and cognitive bias, for example. You don't hear that discussion much in that space.
You're right. I mean, I think that, you know, to me, like this thing, when I kind of discovered this thing in 2020, like during COVID, because I just wanted to see like, okay, what's gonna kind of like what if the market peaks, or what happens when the market ultimately rallied super much, right, and so forth. Yeah. But it's just like, I was just like, what if we have like downside risk, like where to invest and all that. To me, like this, I've been like very happy, because it kind of like, it aligns like a lot with investor intuition. It's some of the things I see in real life, like from speaking to other sponsors, as far as what the markets are that are, you know, like kind of overheated and so on and so forth. And it's just like, kind of like very soothing also to know that, because, you know, if we're now in stocks, there's nowhere where we can be perfectly calm, right? Or something, your stocks can decline still. I mean, maybe now are very relatively low prices, but still. And so these like undervalued, you know, like the global financial crisis, 12 states that were undervalued, the average decline was 4%. 4% only, that's it. So undervalued markets, and that's why I did this presentation now at Cash Flow Champs, by the way, this week. And so I was mentioning that thing. It's like about like investing in undervalued markets. That was my topic. And so, so undervalued markets, very small declines. Metro areas, they were, even though the market was so overvalued, 06, there were 140 metro areas that were undervalued out of the 400. It's interesting, not so few. And they actually, the metro area average decline was like 6%.
Wow.
6%. So it's like pretty protected. But again, I mean, that's on the back end. I know there are challenges to that, because a lot of those markets are not the nicest to invest in, or there's operational risk and all that stuff. But this is purely the market risk side, you know. That's all.
Absolutely.
And it's interesting. There are other things, you know, like, last thing, just before I close, that was just because you mentioned, besides the market side, another thing, I haven't been like too ahead with it, but another product that we have, like this one.
Oh, yeah.
On the property side. So this one, so we use rental listings data, and we try to model off-market commercial inventories for which ones have the most value add based on rental.
Oh, nice.
Yeah, and sort of give, let's say, like in different, sorry, this is not to be looking at different like markets, let's say, what are the sort of gives you a ranking of all the off-market buildings, the ones that have the most potential, that have rents below market, but also have like other things, like for instance, there are other income components too. Let's say they're charging like, what fees are they charging? Like pet fees, administrative, all those kind of, you know, like amenity fees and stuff.
Right.
And also, like, are they billing their utilities to their tenants, and relative to the immediate neighborhood and the same property class? So sort of like we collect the rental listings data and model kind of like preliminarily, doing like some super preliminary, it's not accurate, but super preliminary modeling for kind of like income expense, where you get the highest value add percentage, which buildings show upside. And so it's a simple thing, but it just leverages like rental listings.
Boy, and I think it'd be interesting to get a hold of, I don't know if you've seen Urban Land Institute, and I haven't looked at this book in a long time, and I tried to find it. I actually had it at one point digitally, but I can't find it.
Yeah.
They did a book called Dollars and Cents of Multifamily, and I think they quit doing it mainly because it was very static. I mean, the numbers, like every year they would do it every couple of years. And just generally, you could say, on average, a multifamily was 50% expense ratio. So literally taking that product you just had and then pulling the dollars and cents type of stuff, and you'd have a really pretty good idea of what neighborhoods and what product to look at. I'm really fascinated by this product. This is really cool.
That's kind of what you're saying. That's kind of how it is. Yeah. Then you make assumptions on expense ratio. You make assumptions what percentage utilities are typically within those expenses, and you just try to model out the final thing, to spit out what is the percent. It's a simple model. It's not even mathematical. It's just like model out what's going to be the final, value add percentage. It's just trying to, let's to the best guess all the data that we have out there on rental listings, because they're off market. We don't know anything about these buildings, right?
Right.
But that helps you like kind of model. You can do like, let's say people who are interested in direct to owner, calling owners or whichever, they can go, and instead of like calling each one in every market, maybe they're in few different markets, they can do like top 25% of them in 4 markets, or just like extra data point, right? It's an extra, it's like an intelligence on top of it type of thing. So
but it sure makes sense. It's like if you want to focus your efforts, it's a great way to filter a lot of the noise out, and like you should really focus on this.
Exactly, and it's not accurate because that's like you're not gonna know the real financials and so forth. But it's still gives you a guess, right? Like gives you those buildings show potential, and so this another. It's not in CoStar. I've done like CoStar. They have obviously CoStar has everything, but they haven't decided to do, let's say, this, so it kind of decided to add it as something, and so that's about it. That's, by the way, like there's a guy, Constantine, is on this call. He's my friend. He originally had the idea for this thing.
That's really cool.
Kudos. But that's like other things. But again, like most of the stuff, like Douglas, I don't think it's quantity. I don't think it's quants per se. That's kind of like my company. I code it a little like this, right? Realty quant, but it's a little bit of overstated. It's not like quant, but it's just like doing more.
Stefan, it's just marketing, man. We just got to market.
Sure, yeah, that's true. But it's kind of more data-driven side and whatever. But the market stuff, it's really useful, man. I can tell you, I've been using this thing, that overvaluation thing. It's really useful. Like I've been very happy with it because it's one of those simplest things. It's one of those, like people like Warren Buffett says, like we don't do like complicated stuff. We just you do like simple stuff because you want it to be so accurate and obvious that even with the simplest model, you're going to see it.
And I love what he said. He's like, find stuff that's so good that an idiot could run it, because someday someone will. An idiot eventually will. And I really like Munger. Actually, Munger's more my kind of like my, if I have an avatar, because he's lawyer and quantitative, and it's like, oh, that's okay, this guy here. But Munger talks about the too hard pile, and so even as geeky as I am with the quant stuff, and I want to know more about it, and like you heard me, want to play with Monte Carlo and see what I can do with it. It's like, okay, but are you trying too hard?
Right.
Yeah. It's good stuff.
So, Douglas, let's connect.
I'd love to.
So Stefan@realtyquant.com is my email. Just
will do.
Write to me, and like we can text afterwards and so forth.
For sure. And I'd love to have you on the podcast to talk about your product, and I'd love for you to get it out there in the world for your lenders, because I can see where the lenders really benefit from it for sure.
Oh yeah. So what's absolutely. Send me an email on that one, and I'm gonna.
I will.
Absolutely.
That'd be awesome.
That's great. Cool.
It's great to meet you, Stefan. Have a good night.
Great to meet you too. Thanks to everyone for joining tonight. Have a good night. Bye.
All right. Thank you, Stefan.
Thanks, Sheldon.